Good afternoon, everyone. My name is Brian Overby. I am the Senior Options Strategist at Options Play. And we're going to do a fun seminar today about generating income monthly with puts. Last time around, a couple of weeks back, we looked at generating income with calls. Now we're going to look at puts. And we're going to go into detail as to which puts you want to target and why you want to target these puts in general relative to the other expirations and strikes that are available. So to start with, want to make sure that everybody knows some of the housekeeping items here in that if you look at your navigation bar in Zoom, you will see a chat box and you will see a Q&A box. The Q&A box has a question mark on it. If you have questions during this event, please feel free to put it in the Q&A box and I will try to address them as we go along. If you do put something in the chat box, the chat box is mainly just for the host and the presenter. So I'm not even sure if you have it enabled, but ignore the chat box is basically the rule of thumb here. But we are open for questions. So if you're hearing me okay and everything's working just right, just put a 1 or a 2 or a something inside the Q&A box, and then we'll get going. All right, thank you, Justin. All right, I guess here we go. All right, so options education. We're doing events with First Trade, luckily, every couple of weeks. And we have a whole set of educational events that are put together. We currently at this stage, we're looking at doing covered calls. We're going to do cash secured puts today or selling puts. And then we're going to talk about the wheel strategy, where we're going to put everything all together. Tony Zhang, the chief strategist at Options Play, is actually going to do the third part of this series. And I actually took the time this week because of the volatility in the marketplace to try to update a lot of the slides and look at a scenario, because bottom fishing is a thing right now, right? The markets are very rough, very volatile. And if you do see some underlyings that you wouldn't mind owning, selling a put to buy those underlyings is a very interesting trade to do. Now, some of the numbers are a little bit tougher, mainly because there's so much premium in the marketplace that it makes it easy to find puts that you wouldn't mind selling. But I do want to go, I don't want to start running before we walk here and get established what an actual cash secure put is. And I ask, are most of the people out here, have you done a cash secured put? Do we need to go slowly through the basics? And if we do, feel free to slow it down and ask me a couple of questions along the way. But we at Options Play want to highlight that we will be showing our software today. And if we do show the software, none of the stocks are meant to be a recommendation. Past performance is not a guarantee of future results. We'll be looking at some yield percentages today, and this video is not intended to be used for legal or tax advice. On the brokerage side of things with First Trade, if you ever trade options, it's important that you receive a copy of the characteristics and risks of standardized options, otherwise known as the ODD, and you can receive that basically everywhere within the First Trade website, or you can obviously ask your broker to receive a copy of that. All right. So who is this portfolio for? Well, you can make the argument that this is speculation and long-term investing. I like to look at it more as a long-term investing strategy. This is a strategy that you can try to implement where you're trying to bring in income above and beyond any dividends that a stock may pay. And a lot of times when you're looking at especially, I think we're fine here. I'm getting everybody okay? My computer's hollering at me saying it's not really happy. Is everybody hearing me all right? All right, good. Thank you, Alan. I appreciate that. Yep. Okay. And I got anonymous attendee says I'm a rookie. slowly through the basics from William. Uh, all right, so we will go a little slow. Okay, so here's the way that I'm going to approach this. As far as, is this long-term investing or speculation? It can be both, and it's the same. And I know that some people might think that you're trying to avoid the answer, but there are a lot of people that I know, including registered investment advisors, people that actually manage money. And the whole way that they manage the money, the whole theme is going to be summed up in next week or in a couple of weeks for the next event when you look at a wheel strategy where you're going to combine the covered call situation with the short put situation. And all they're trying to do is bring income in around the stock to enhance your stock portfolio and make it less important that you get the direction right on the underlying stock, mainly because you're going to bring in income to help offset a lot of losses. So the amount of income is very important, and we're going to go through that a lot today. But with all the comments that I've received so far in the Q&A box, let's walk before we run, and we're going to go in and look at what a covered call is in general. Yvette actually says, I've never done a short put. Okay, so my goal today is to identify stocks that we can sell with clear rules as to when to enter and exit a trade. So we're going to use the options play software, which all First Trade customers have access to. And we're going to use a search that is actually called short puts. And then we're going to talk about passive management, where you're going to be looking, if you're going to be trading options, you need to look at your portfolio at least once a week. Now, if you're speculating on options, you're doing it day in and day out. But this strategy is going to require passive management. You want to be aware of what's going on in the marketplace, but you don't necessarily need to watch it day in and day out. All right. So, what is a short put? Well, first of all, if you think about a put, puts are very hard to get your hands around. I've been teaching options over 20 plus years, and people still struggle when they ask the question about a put option, because if you buy a put, if you pay cash, you get a right. And that right is to put stock to somebody at a specific strike price. And that's where put comes from. And if I buy an option and I buy a put option, that means I'm intending to sell via that put option at a later date. So buy means sell with puts. So on the other side of the coin, if I'm selling a put option, well, that means that I'm willing to buy the underlying stock. I can have the stock put to me. And so the term put actually comes from the sell side of the equation, not necessarily from the buy side. And that's really where options were created from in the first place, is it has a lot of focus that comes directly from the insurance world. If you actually sell a put, you are oftentimes referred to as the writer of the put contract. You sell it, you get premium. For that premium, you take on an obligation. What does that sound like? It sounds like insurance, right? So what do you call somebody that sells an insurance policy? You call them the underwriter of the policy. And when you buy an insurance policy, what do they say you're paying? They say you're paying the premium. And so in the insurance world, there's a lot of synergies to the options trading world, and in particular to the short put scenario. But if I sell a put, what I'm saying is I'll buy the stock, and I'm going to get paid now for saying I'll buy the stock at a later date at a lower price, right? Kind of sounds a lot like a limit order, except for you don't get paid for a limit order. So in this instance, if I sell a put option on a stock or an ETF, we're going to focus on just stocks today, but exchange traded funds, obviously you can trade options on, like the XLE, the Energy Spider ETF, or the XLF, the Financial Spider ETF. So you can sell puts on a lot of different things. The main thing that we're going to focus on today is stock to try to keep things simple. And you got to want to acquire it. So if you're a beginning option trader, we're not selling puts hoping that they expire worthless. And that's the only way that we're going to trade it. We're going to call this cash secured, which means that if you do acquire the stock, you have the capital in the account to buy the stock at the strike price of the put, much the same as if you placed a limit order. Your brokerage firm isn't going to let you place a limit order to buy the stock at a lower price than it's currently trading if you don't have the funds to pay for that stock at that price. So that's the same concept that we're looking at here with the short put option. Okay, you receive the, oops, I didn't mean to do that. You receive the put premium as yield on the cash set aside to purchase the securities. Okay, so I receive cash. That cash I can lower my cost basis, or I can just think about it as yield. And that's what we're going to think about today. But it does create an obligation. It's an obligation to buy, or to, I like to say, have the stock put to you. So here's what a profit and loss graph looks for a general short put. If you do sell a put, you bring in cash. That cash, if the stock starts going up and goes away from your strike in your put, is a benefit that you receive from that put option. So as the market goes up, you have the potential to make that premium. Once you sell a put, you get that cash. You can say, well, I was wrong. You know, the market went the wrong direction. It doesn't matter. You get the cash. You can do whatever you'd like with it. We're going to say that you're going to use it to purchase the stock and lower the cost basis on the purchase of the stock. But bottom line is if the stock runs away from your strike, you can make that. And that's where our max gain is at if the stock stays above the strike price. And this is representing the stock. Now, if the stock comes down, well, you are obligated to buy the stock at the strike price. But once again, you get to keep the premium. So our break-even price will be lower than if we just bought the stock outright. And then we have this obligation. Just like if we own stock, we have substantial downside loss because the stock can be put to us up here at the strike price. And if the stock continues on down, the loss can be substantial. We use the word substantial instead of unlimited because it can only go to zero. That's the only reason why we do it that way. Okay, so I see your question, William, and I'll address it here in just a second. Let me finish this slide. Okay, so in this instance, I just threw up what a profit and loss graph would look like for the stock. If I own the stock, my cost basis is going to be higher because I don't receive the premium, right? And I'm saying here that I'm basically owning the stock at the strike price of the put. So in this instance, I have unlimited profit potential to the upside because infinite prices are feasible, or no, are within the realm. They're not really feasible, but they're within the realm. So you have unlimited profit potential on the upside. On the downside, you have substantial loss potential. Your break even moves up the axis, and it's going to be somewhere where the actual strike price of the put is at. And that is profit and loss for a stock. I sell the put. I have limited and known upside, the premium received. I move the break even down, and I have the same type of loss as I do on the stock, but I got a small pillow to land on, which is the premium. All right, so let me address, and if you have questions about this, I'll let you think about what I just said, and I'll answer William's question here. What if you already own the stock and don't want to sell it, and you expect the stock to go up? Can you sell puts against the stock you own to collect the premium? Do you have to have cash on the side in case you're wrong? There's a lot in there, William. That's almost an entire presentation. But with that said, yes, you have to have cash. And I don't suggest doing naked put options in general, because stocks have a tendency to go down a little bit faster than they have a tendency to go up. And the last month has proven that, right? How quickly we've retraced in the marketplace relative to the gain that we received from the end of the year. It kind of disappeared in a hurry. So you do have to have cash, and I'm billing this as you got to want the stock. So if you have stock already, this is a way to dollar cost average into stock. And the way that I would approach this, William, is if I found a stock that I want to own and say I already own 100 shares of it, if I researched the stock and I figured out that I wanted to buy that stock and I wanted to buy 200 shares, I might buy 100 shares outright right now and then sell a put saying that if the market goes down, I'm willing to buy it at a lower price and get paid for saying that I am willing to do that. Now, I guess I could step back and mention, I kind of tossed it out there, but I didn't highlight it, is that you have to deal with 100 shares of stock. Options represent 100 shares 99% of the time. That's what an option contract represents, as long as there isn't something weird that has happened, like a stock split or a merger or acquisition. So you need to be able to buy 100 shares at that strike price. And you need to, whenever you're dealing with options, this is kind of a downside as opposed to a limit order, right? I could put in a limit order to buy NVIDIA, which is going to be my example here, NVDA, at a lower price, and I could buy 30 shares of it, but I can't do that with an option. There are no option contracts on NVIDIA that represent 30 shares of stock. So that is an issue. You have to have the capital to be able to buy 100 shares if you're going to do this type of strategy. All right, I think I answered your question in general. You do have to have the cash, and this is the way that I would approach it. If I was going to buy 200 shares, I would buy one now and sell a put against that position. But I'll get into more detail on the philosophy that we like to teach at Options Play if you're doing put options. And I want to emphasize, this isn't the only way to do it, right? There's going to be some argument. Some people are going to have different opinions inside this that are attending this presentation. But this is the way that, this is the dynamic that we put into the platform at Options Play. All right. So let's walk through an example here. Now, I thought that this is a real life example. Now, it's a little bit expensive stock, but in this day and age, $100 stock is kind of normal. NVIDIA, the semiconductor stock, if you've known it, if you know, one of the, at one point in time, was one of the largest company capitalization weighted in the marketplace. So almost everybody knows NVIDIA. And if you know NVIDIA, you know that it's been taken out to the woodshed, if you will, and beaten up a little bit recently. Even though they had strong earnings, the market came down. So here is a great example of a stock where you might have an opportunity. If you missed the run up the first time around with NVIDIA and you wanted to buy 100 shares of stock, then this is a situation where you might do that, right? Now, we're going to say that we have a target price, because if anything, when we're doing option strategies, you're usually looking at a 30-day, 60-day, 90-day, or even a 1-year time frame. You're not necessarily looking at it for the long term, but you can obviously implement this for a longer term strategy. So we're going to look at buying NVIDIA as a limit order and buying it with a short put. So on this day, NVIDIA is up strong today, but on this day, the stock was at 107. And I rounded off a little bit. I think it was 106.98. So I added 2 cents to it to make it 107 to make the math simple. You're buying it with a limit order. So if we buy 100 shares of NVIDIA at 103, that would cost us $10,300, which is 103 a share. So you take 100 times 103, you come up with $10,300. If you were going to buy it, if the market came down to 103, that's our goal. We want to buy it at a lower price. We think our upside, if we do buy it, is around the 120 level. And if you look on the chart, that's kind of maybe a little resistance area for NVIDIA in the short term. So if you are doing that type of strategy, that's the way you would look. So if we did buy it at 103 and it ran up to 120, we'd be making $17 a share, and that's $1,700. Now, Here's a great example. Volatility is up a little bit. The marketplace is a little nervous. And if you know anything about volatility, if you think of what I mentioned earlier, that options are a lot like insurance contracts, when is insurance on your house going to be the highest, right? When the hurricane, you're living in Florida and the hurricane has already been uh, mentioned inside the weather forecast and it's heading towards Florida. That's when the highest insurance rate would be, right? Most insurance companies wouldn't sell it to you. But just for the little anecdote that I'm just saying here, when there's a known risk out there, that's when insurance can be the highest. And that's also the case in the options trading world. When markets are shaky and people are scared, option prices will increase, and in particular, put options, because it's a way that you can protect your portfolio or your stock by buying a put. So we're getting decent premium. This is a time where selling put options to buy a stock is something you might want to think about. Now, hard time to be buying stocks, but a lot of people in general want to buy when the market's down and want to take that opportunity. And this is one way to get in a stock at a lower price. So if we look at NVIDIA, we're going to go out about 30 days on this trade. And this was, real quotes from the markets, not meant to be a recommendation. I want to emphasize that. But we sell NVIDIA at 103 put and we bring in $5.25. That's $525 for every put. Now remember, each put represents 100 shares. So in this instance, if the stock comes down to 103, they can put it to us at 103, but our cost basis is actually 103 minus 525 or $97.75. Total cost is $9,775 versus the risk over here of $10,300. So we have lower risk because we got the small pillow. Well, it's not a small pillow. $5 is a big pillow, honestly. And it has a little bit to do with where the market is at. Now, the difference is quite a bit also. We're buying this about 5.5% lower than the 103 level. So our reward also goes up relative. If we do hit our 120 target, we would be up 22.25 a share or $2,225. So here's the profit and loss graph. If you buy stock at 103 via the limit order, substantial upside, looking to hit that 120 target, substantial downside because you own the stock. And then in this instance, stock price at 103, well, we received the premium, so we moved down the x-axis on our profit and loss graph, and our cost basis is now 97.75 as opposed to 103, which gives us a lot more upside potential on that trade. All right, so here's the I guess here's a different way to look at the obligations if you're put the stock and if you're not put the stock. So based off of NVIDIA's price just recently, the stock was down at 106. This is actually a chart of NVIDIA. And talk about catching a falling knife, right, to the downside. And they actually had strong earnings. So the stock got beaten up after beating on the top and bottom line and actually had a decent forecast going forward. But we know right now that it's all about the headlines as far as the market in general that are really driving the market and where the market's going. So we sell an NVIDIA 103 put, $5.25. You have to put up the $9,775. Now remember, it's 100 shares. So if you don't have that cash, this strategy won't work for you in general. And we're once again, I don't think I would have ever done a webinar for retail clients that that centers around just selling naked put options, meaning that you don't have the cash and you don't want to buy the stock. It's just a very risky strategy, and you need to trade for many years before you want to try sticking your toe in that waters. Okay, so here, based off of the chart, the stock's at 106.98. If it comes down to 103, right, and you get put the stock, if it's below 103 at expiration, you will be assigned. You will buy 100 shares of NVIDIA at 97.75. That would be your cost basis, which is $5.37% below the 103 price, as opposed to if you put that limit order in. Now, on the upside, if the market returns and goes to the upside, you get to keep the premium. Like I said, once you sell it, you get it. So if the market goes away from your strike, this expires worthless. You keep the premium. You may be sad because you missed out on some upside opportunity, but you get this over a 30-day period. So this is a 30-day option contract. So you're looking at a short-term period returning 5.3% yield for being wrong in this instance, because we're saying you want to buy the stock, and we mentioned that, and the market's running away from the stock. Now, in our example, if you look at the marketplace going to up, let's say 17 points divided by 103, you're looking at 17 points to the upside divided by 103. Yeah, there we go. You're looking at 16% upside, 17% if I round up. So your goal in our instance is the target price of 120, which I'm kind of highlighting here on the chart. This is the only reason why I picked that 120 level, because there might be a little bit of resistance right in this level, but it's a strong move to the downside. The next level would be right up here, right just south of the 130. And then before all of the trials and tribulations started, this whole thing happened when the stock was up at 140. All right. So if I'm looking at this trade and I'm doing this, I'm looking at, well, my goal was to try to make about 17%. I'm wrong on my forecast, and in a short period of time, I can make 5.37% overall. Not a bad alternative, especially in a volatile marketplace like we're talking about right now. All right, any questions on this slide? All right, good morning. Is this a covered call strategy? Luis, this is not a covered call. This is actually cash secured puts, but it's an alternative. It's instead of saying I want to sell my stock at a higher price, I'm saying I want to buy the stock at a lower price, and I'm receiving premium for doing that. All right. Now, this comes directly from the Options Play platform. And I just grabbed the screenshot. And if you have a First Trade account, you've probably seen something similar to this inside the Options Play platform. If you've ever received a quote on an option contract, it's easy to jump over to the Options Play platform and look at this. So I'm going to use one of the features inside the platform that is available to all the First Trade customers. We're looking at optimal short puts. And as I mentioned, this was put together not that long ago. This was about 30 days away to expiration, and done a lot of back testing, a lot of iterations, and in most cases, a 30-day option contract is optimal. And I'll talk a little bit about that. I'm going to address shorter term options because I can feel the questions coming already. But we're gonna stick with our guns here, that if you're doing a search within Options Play, we're going to offer you, first off, depending on your settings, 30-day option contracts. That's what we're going to default to, because we feel like that is one of the best option contracts to give you a solid yield percentage on stocks that you want to buy. Once again, cash secured. We have the cash. We're willing to buy the underlying stock. Okay, so when you put NVIDIA in and you click on the income strategy, what will come up based off of your settings under income settings, and this way I have this set up to do the default income settings for Options Play, and it will highlight these are puts that if you're doing them, we will give you a decent annualized and a real rate of return. Raw return is what we call it. Basically, how much you could return just from that one option contract. And the first one that we have checked off here is the 103 strike put. So I have it highlighted in green. If I sell the 103 strike put, which it would default to based off of those settings, I'm selling the April 4th, which is 25 days away. It's close to 30 days. It's not quite. And you'll notice here that we're highlighting this as 20 to 39 days. There might not be an exact 30-day option contract available. We're working with what you're given. And it's trading for $5.25. Now, the delta is something that we use to try to figure out these other put options, but I'll talk about that in just a little bit. Okay, so let's get through the yield area. So we're bringing in $5.25. Here it's highlighting it here that's $525. That's your max reward. If the market goes up, highlighted here on the profit and loss graph, and you're above the strike, you can make that $525. Our break even on the downside is the strike price, which is 103 minus $5.25 or 97.75, and we have 25 days to expiration. Now, probably the neatest thing, for lack of coming up with a better word than that, is that we show you the yield. If this stock goes up and you're wrong, because we're billing this as you want to buy the stock, right? And the market goes up, you can bring in 5.37% over the 25-day period, which means that if you were able to do this every 25 days for a year, the annualized return would be 114%. Now that's a ridiculous amount, and you'd have to be right every 25 days in this instance and get this type of premium. But it's highlighting the power of cash secured puts by showing you the annualized rate of return if you could do this every 25 days. And grab a little sip of water. All right. Now, if you loosen up your settings a little bit, it's not going to highlight this one. It's not going to quite show. Oh, let me do the delta. I'm sorry. Okay, delta here is very similar to the probability of expiring worthless. That's what this number is right here. And it's saying it's 54%. We like to look at delta. Delta will also give you a number that's similar to this. Delta is the probability of your option contract finishing at least 1 cent in the money. So if you're selling something that's fairly close to where the underlying stock is at, right? We're going to call it 107. We'll round up to 107. We're selling the 103 strike. That means there's a 40% chance at the expiration date, based off of just general math of the marketplace, that this option contract will be at least 1 cent in the money on the expiration date. And we use that to try to figure out these different offerings of option contracts within the 30-day range. Okay, so the 40 delta, the actual delta for the option was 39. It's close to 40 in this instance, and that option contract will yield 5.37% or 114% if you could do it every 25 days for a year. Now, if you go to the next slide, okay, that's highlighting the 95 delta, and if you tweak your settings a little bit, this would be the one that it would offer. You are a higher probability of not getting assigned. The delta is 30. In this instance, in the real world, it was 25, so this means approximation. And the yield would be 2.95%, or on a yearly basis, if you could sell similar options over and over again with 25 days remaining, you would get a yield of 52% on this situation. And then if you tweak your settings a little bit more, you can go down and you look at the 90 strike delta, right? You're the 90 strike put. and you're still getting a good amount of premium. We're still targeting 30 days out, so the days don't change, approximately 30 days. The delta that is targeted is around 20, but it's actually highlighting here as 16 delta. Yield 1.97%, still a decent yield. Like if you think of dividend yield on a stock, a 2% dividend yield is a great dividend yield, but that's for a year. We're talking about a 1.9% yield, income that's came into your account for 30 days, just saying that you're willing to buy a stock that you like at a lower price, at that strike price of 90. And then you have 25 days remaining until that expiration date. So based off of the settings and the search inside the options play platform, we're saying this is some criteria on puts if you like NVIDIA and you're willing to buy the stock at the lower price. But you have to have the capital to be able to buy that stock at that lower price. Now, in this instance, on this last option contract, here's a helpful thing, right? The break even is $88.26. So you need $8,826 to sell this put, as opposed to $9,775, if I remember correctly, to sell this put. A little bit less capital intensive overall. And that does get reflected in the yield because you don't have as much capital put up to sell that put option. All right, so I have my first quiz of the day for you. We have just looked at 3 different puts, and my question is, and I want you to get ready to put this in the chat box. I got big number 1, number 2, number 3 on your slides. Which one do you think is optimal? And there's no actually wrong answer. Just first of all, I want to make sure that I keep you awake, right? So I want to ask you a question every now and then. And it's always good to get a feel. Which one would you want to sell in your account? And you have to play in my reindeer games or I can't move on. So you have to use that Q&A box, the one that has the question, and you have to put in an answer if you're attending. Well, so far, we're about equal. We got 1, we got a 2, we got a 3, got a 2. 3 is the least amount. Chris jumps in here at the very end here with a number 1. William tossed in a 2. Anonymous came in with a 3. Gosh, I'm gonna call it a tie across the board. And I appreciate you playing in my reindeer game, but that's what I'm seeing here. Okay, so what we have determined, and I'll give rationale behind this, at options play is that number 1 is the optimal trade that you want to do. And this is a little bit about, are you using this in your long-term portfolio to try to get yields above and beyond what you do if you just bought the S&P 500 index, right? And the rationale here that goes along with this is, what if you're wrong? What if the stock doesn't come down? What if you miss out on that opportunity? Which, bluntly, this is a real life example. If we had sold this put when NVIDIA just the other day was at 106, we wouldn't be put the stock based off of where the market is at, right? NVIDIA is up today trading at 115. So we missed that opportunity. Now, if we missed that opportunity and we sold the 20 delta put, we did okay. We brought in $1.74. Our yield was 2%. It's solid. But you think if you're doing this on a long-term scenario where you're always trying to sell puts to buy stocks that you like, and every time that you are wrong and you don't get to buy the stock, so once again, I'm trying to beat home that we want to buy the stock, because a lot of people that sell puts think they want them to expire worthless. We're trying to buy the stock. This is an alternative to a limit order. You make 2% every single time that you're wrong. Or you're wrong and you make 5% every time that you're wrong, right? 5% is solid. That's a solid return in the marketplace. The S&P 500 index over years and years and years on average returns around 10% on a year in, year out basis. Now, it's hard, you might scoff at that because the last couple of years have been extremely strong. It's part of the reason why we're selling off a little bit harder than normal, because we've had 2 really good years back to back in the marketplace. But with that said, it's all about, I'm okay with making 5% on a stock, right? And you're doing it in 30 days. If you did it every 30 days, you would make 114%, which is, I think, astronomical. And I sometimes don't like putting it in a slide because that's obviously an insane amount of return. But if you could do that, and you're wrong every month, and every month you sell an option that returns 5%, at the end of the year, you're okay that you didn't get put to stock, right? Because you're making a decent yield on the option contract that you are trading. Now, you might get put to stock. You're trading something closer to where the stock is at than here. But once again, that's your goal. So you don't mind doing it. So looking at a 40 delta, 40% chance of getting put to stock on an option contract that is closer to where the marketplace is at, right? To where the underlying stock is at, will give you a better yield. So to me, the short put strategy isn't about trying to earn incomes by your short puts going out worthless. It's about, what do I get if I'm wrong and the stock doesn't get put to me and I don't get the opportunity on the upside to make some capital, right? Now, that's not a golden book of answer. Like if you grab the golden book of option trading, which might be right back there, that's actually my book, the options playbook. But if you grab, I'm blushing. I can't believe I actually just did that. But if you grab the golden book of option trading, it's not going to say that number one is always the best scenario. It's what's best for you. A lot of people said number two, and I get that. Now that's a decent return just overall. You're still looking at a 50% rate of return, and this is feasible, right? 3%, you're looking at a 30% chance based off of delta. Well, in our real life example, it was a 25% chance based off of our numbers. And everybody gets this, right? That this is the real world number, and this is what the software was searching for, somewhere close to a 30 delta. Okay, just so you know, I want to highlight that if you get the return. And if I got to define delta again, I'm happy. We're not looking at the textbook definition of delta. We're looking at delta as a probability. And actually, I got a little anecdote for that. So we got a lot of basic people that already raised their hand and said that they were basic. If I look at delta, I used to work on the Chicago Board Option Exchange back in the day, and the traders on the floor always talk delta. Delta's probability, not how much your option's going to move relative to a movement in the stock. They think of it as probability. So if you ever ask a trader a question, almost all the time you're going to get an answer in delta. Hey, Bobby, you want to go to the Cactus across the road and get lunch today? Bobby, 10 delta. I got a lot going on. The markets are rocking and rolling. Get back with me at around noontime and we'll see. But right now, the delta on that lunch date is 10, or a 10% chance that I'll do it. And then the market closes and you say, hey, Bobby, you want to go to happy hour at the Cactus across the street from the Chicago Board Option Exchange? And he says, 90 delta. Oh, I had a rough day. More than likely, I want to go, saying there's a 90% chance that he would want to go to happy hour and have a beverage after the tough trading day that he had. And it was kind of funny because back in the day, the servers at the Cactus, which was right across the street, which is gone now, which is sad. But back in the day when I worked at Chicago Board Option Exchange, they were there. The servers always had shirts that said "Don't drink and trade" on the back of them, as opposed to, the good old "Don't drink and drive" scenario. So yeah, delta probability, and that's the way traders on all the floors talk. They always toss out a delta when you ask them a question, because they're all about the math of the marketplace. All right, and that's how we're using it here. So we're saying a 40% chance. Because it's a 40% chance, not a 30% chance, we're going to get paid more. We receive more. What does that more mean? That means more yield overall. Now, in this, you can go out and you can tweak your settings. You want to look at options that are 40 to 70 days. Guess what? You're going to get even more yield. You're going to have less opportunities to do it. You're going to be more hands off. But let's say we're wrong, like we were on NVIDIA, right? And I kind of expected this to happen, actually. And so it worked out to be a great example with NVIDIA in that, well, now if I do a 40 or a 70 day, let's say we do a 45-day option contract, it turns out that that's where this expiration is at. Now I'm maybe getting $6.50. Now my yield's 6 or 7% for being wrong and not buying the stock. Then that means less that you have to do to manage your position. And this goes all the way back to my goal at the very beginning. Do you want to be more passive in your management, or do you want to be more active in your management? Doing longer term options, getting more premium up front, means that you can be more passive. Now, you still got the downside risk of owning the stock, and you still got to be aware of that, right? And a lot of people will ask, well, what do I do if it goes down? Well, what'd you do if the stock went down? If you sell it, if that's the way that you're going to do it, and you say, I'm down this percentage, I'm going to get out. You can do that. That's okay. Or do you want to do the Warren Buffett style of investing and just, okay, I got to put the stock. Now it's time to start holding. And if you want to, then you perform the wheel, right? You come back and you sell calls against the position. All right. William says, do you have traders that might do more than 1 or 2 contracts? Yeah, definitely, William. NVIDIA is a $100 stock, and it is hard to find this strategy in my mind. A lot of times when I put slides together, I always try to find a stock that's $25 to $50, so it's more feasible to buy 100 shares at those prices. But it's hard to find yield. And once again, one of the most important things is that this is a stock that you like, that you've done the research, that you want to buy the stock. I don't want to just sell the option because the premium is high, right? Because I'm getting a good yield. I want to sell, like in this instance in NVIDIA, you're getting a really good yield because the stock is down and the market is down and volatility is up. So I want to highlight that. Sometimes it will be hard to find a 30-day option contract that yields over 5%. That might be in NVIDIA, if it goes back to 140, where like from the chart, that's where everything started, the 30-day yield might only be 4%. Right? Because the markets came back and implied volatilities came off and there's less perceived risk in the marketplace. So I just want to keep that real. But yeah, you do more than 1 or 2. William, here's what I usually will see with people that are doing puts is exactly what I've laid out to you with your first question, in that I like NVIDIA. I want to buy 200 shares of it. I buy 100 shares now, and I hope that the market goes up, and if it doesn't, I sell a put saying I'll buy another 100 shares later. And that would have been a great scenario when NVIDIA dropped down the first 15%, right? It's down more than 30% now, but say the stock went down to, when it went from 140 to 120, and I can run back to the chart, right? Let's go back to the chart here. So if you think of it this way, NVIDIA announced earnings in the middle here, but we come out and this was after earnings and the stock hit 120. So at this point you say, okay, I will buy my first 100 shares And I hope that we go back to 140. But then I'll also sell a put down here, let's say at 115, $5 below where the 120 is at. Well, in our instance, how many points were we below? It was 107. It was 4 points below, right? So we'll say 116. We'll keep it relative. So I sell the 116 strike put. Hopefully that's available. And I say if it comes down to 116, we'll buy more. So we own it at 120. We want the market to go this way. It doesn't go this way. It comes down. We sell the 30-day 116 put. We bring in $5 approximately. It should have been trading somewhere close to that. And we end up buying it at 111. Guess what? The market is right here when that all happens. And now the market comes back, and now we're at 115. Just a perfect scenario if you want to talk about selling cash secured puts is NVIDIA right now at this moment in time. Okay, so there's our slide presentation. And that's why we came up with number 1. That simple. But as far as options are concerned, time decay is a real thing. You guys ready? You ready for this? I know this is a basic option trade, but options decay at the square root of time. I know that's an exciting concept you might want to stop and go tell your friends and family about. But bottom line is, if you look at the decay of an option contract, it decays slower in the life on a longer term option contract than on a shorter term option contract. So once again, I told you I've set this presentation up because I anticipate the question, because everybody wants to trade in this day and age short term, often referred to as 0 DTE option contracts. And that's fine, but you just don't get as much premium. So in this situation, we have a 90-day option contract. We're focusing on a 30-day option contract, right? And this is the time premium of the option. This is the days to expiration. We're calling this an at-the-money option. It could be a call. It could be a put. Time decays at the same rate across the board. Things that can affect time decay just in general or time value is implied volatility. And we mentioned that, and that's for a different day, different conversation. But when a 90-day goes down to a 60-day, it's a fairly linear rate of decay. A rise over run, right? This rise over run is 1/2. It's very straightforward rate of decay. When we go from a 60-day to a 30-day, the decay accelerates a little bit. Not quite as flat as it is here, a little bit more. But when a 30-day goes to a 0-day, it's like, wham, my sled hit the tree, right? And especially in the last couple of weeks, you get a large rate of decay. So if you're selling these option contracts over and over again, you're going to do really well if you're correct on your outlook or your approach, right? Because this is where in the last couple of weeks, or in particular the last week, you get the highest rate of decay. All right, Yvette, I see your question, and I'll address that in a little bit. So I went out and I looked at a short-term option, otherwise known, well, everybody know the term 0 DTE? These are basically option contracts that have 1 day to live. And I don't know why they don't call them 1 day, but they call them 0 days. Because if you look on the option chains or in the calculator, once the market opens, they basically say they got 0 days remaining to expiration. And I did a little AI graphic here. We got the 0-day option contract fighting the longer term option contract. So why not do a shorter? What about a 0 DTE option? Well, if we do it, we obviously expect to receive less. So in this instance, the 103 put, to keep apples to apples, right? We talked about the 30-day 103 put. Here's the difference. Here's the trade-off. 3 days remaining to expiration on this one when I grabbed this screen graph. And this is once again from the Options Play platform. And I highlighted a different section. We were looking at the options grid inside the Options Play software when we were getting the grid of different options that were being recommended as decent put options to sell on NVIDIA. Now I clicked on the strategy in the Greeks, and I made this fit a little better, but I cut and pasted it, and it's showing the delta is 15. So the fact that we have a shorter time frame, and it kind of makes sense when you think of probability, right? You got a shorter time frame, 3 days, and the stock's at 107, and we're selling the 103 put here. We're 4 points out of the money. You're going to have a lower probability of being assigned. So are you okay with that? Is that kind of your goal? So keep that in mind, that delta will change as expiration approaches, and it just makes sense. If you think about the probability of the stock moving 4 points to 103 over a 3-day period, or moving that same amount over a 30-day period, there's obviously a higher probability that it will happen over a 30-day period. All right, my cough is kind of catching up to me. So the delta will reflect that, or the probability will reflect that. And this is where the probability of worthlessness, which is a thing that we calculate, try to make it, because delta can be confusing, right? So this is showing that there's an 85% chance that it will go worthless, or the delta saying there's a 15% chance that you will be assigned. You put the math together, it adds up to 100, right? It's got to add up. Now, it doesn't always work out exactly. This formula isn't exactly the delta. Actually, the delta, this is actually more accurate in my mind. Delta, like I said, it's an approximation of probability. It's not the textbook definition of delta. All right, so I'm talking too much, but you get it, right? So, okay, 83 cents. Well, 83 cents isn't $5. That's for sure. So if we look at the shorter term versus the longer term, here's the situation. Not saying, once again, that this is the wrong way to do it, because on the short-term option contract, that's real money being at 103, and it has a lot to do with what I just showed you on the time decay chart. I mean, you're getting a lot of premium that's got to go away in 3 days. So the 103 strike 83 cent option contract times 100 gives you $83, is a 16 delta, rounded up on that delta here. And the yield is highlighted here at 0.81%, but look at it on an annualized basis. That's 167% annualized. Now, what is it doing? It's taking X number of 3-day periods, which I already did the math down here, over 6, and it's saying that if I look at this in how many 3-day, that was the price. I screwed myself up by looking at that. 1 second. How many 3-day periods are there in a year? And what if you sold in a contract for 83 cents and they all expired worthless every 3 days? And then that's 167% yield. But there's a lot in that, right? You're saying that the stock's never going to come down. You're never going to get put. You got a higher probability of that happening. But every 3 days, that possibility goes away, and you're going to make 83 cents every single time you do it. But what if on the third 3-day period, you could put the stock? Well, in that instance, then you're going to make 83 cents 3 times, and that's $2.49. Very feasible, but you're still not $5. And what if the stock takes off at that point in time? Well, then your yield's cut in half. You're not making that 5% yield. You're looking to make about 2.5% yield. So a lot more risk if the stock runs away from you in this instance. A lot more reward if the stock continues to expire worthless and you're able to continually sell 83-cent option contracts with 3 days remaining to expiration. So in the other instance, in our 103 strike that we highlighted earlier, 525, 40% chance based off the difference here is time. and the yield is 5.3% or 114 days every 25 days. So in this instance, to get that 25-day thing, 25 divided by 3 days is 8 periods. So you'd have to do eight, you'd have to sell this 8 times in order to, over that 25-day period, to capture the same amount that you're receiving right here of the $5.25. Do you want to buy the stock? That's another question. So once again, if I'm selling this option contract and I'm looking for scenarios like this, I probably don't want to buy the stock. Let's get real, right? I'm doing this hoping that in 3 days the stock doesn't come down and I don't get put to stock. That's ideally what I'm looking to do. So in order to do this, if I'm looking at doing this type of trade, I have to ask myself, yeah, do I want the stock? Do I really want the stock? And if I'm doing this over and over again, so the answer might be, you might answer that, no, I don't. I want to try to make premium selling this. I'm going to have the capital to pay the stock or buy the stock if I get put it, but I'm hoping to do this, as I said, 8 times over the next 25 days and capture that amount to get to that 525. That's simple. All right. Any questions on that? So I'll go back and emphasize. There's no right answer. There's no right answer. Everybody's going to be different. This is obviously going to be active management as opposed to passive management. The further you go out in time, the less you have to watch it. You might want to set an alert if the stock does just plummet, which a solid stock like Nvidia, as far as earnings and revenues and everything is concerned, did plummet, went down 30% before it has made a turnaround. But not to say that it won't go back down tomorrow, but just in general, before we got the bounce back up a little bit. So yeah, you probably might have watched that one. You might have closed out the put and said, I'm going to buy to close and not accept that assignment. You'd have a loss on the put, but you could have done that. That's an alternative. Just like you could sell the stock if you're worried about the downside on the stock. And that comes back to Yvette's question that I see in here that I've been waiting to answer. Do I need to wait until expiration to close the trade? If I don't close it and it expires, or close it at expiration, what could happen? Yvette, you could get put to stock. So if I go back to the scenario here, let's exit this. I'll just do it this way. If I go back to the stock scenario here, right? And we talked about selling the 120, buying 100 shares at 120 because you like Nvidia, and then selling a put at 116, saying that you buy the stock at a lower price. Well, if you look at that scenario, if the stock went down to this level from 116 on down, you're going to get put to stock. You got to buy it. You can close it. And a lot of people will. Most of the time, people that trade options will buy the option contract, and if it goes up, right, if they're buying the option contract and they buy a call option and it goes up and they got a profit, they sell it and get out. They buy the call option and it goes down and they're losing money, they sell it and get out. You're buying to open and then you're selling to close. That's the vernacular that you would use in the options trading world. And if you're selling the put to start with, and you're saying, I wouldn't mind being put to stock. Oh, wait a minute. Nvidia just dropped 15%, right? I don't want the stock anymore. I don't want the cheese. Just let me out of the trap. Well, if I own the stock, I could just sell it. Well, guess what? I can buy to close my option, and I can remove my obligation if I wanted to do that. I will have a loss. I won't get put to stock. I will have a loss on the position, but my pain will go away, right? I won't have any more risk in the marketplace in NVIDIA and VDA. So, you know, if you're doing this strategy, some people will just do it. And once again, go back to the intention, the first one of the first slides here. Are we doing this as an investment in our long-term portfolio, 80% of our portfolio, or are we trying to do this as a speculation trade, which is usually about 20% of somebody's portfolio? So if you look at it that way, and we're doing this trade as as um, as a longer term investment, that means that I wanted to buy the stock, and I think Nvidia can bounce back, and it's okay that you put it to me. And so we're going to sell that 30-day option contract. We're going to wait 30 days, and if the stock's below 103, below our put strike, we'll take the stock. And if it's above it, oh well, go ahead. We made 5% for being wrong on our outlook in a 30-day period. All right, so that is basically the end of my presentation as far as my slides on puts are concerned. We're going to talk a little bit more about some of the challenges and how options play can kind of help you out. But selecting stocks that meet your investment criteria, that's obviously a challenge. I don't want to sell a put just because there's premium. And that's it. I want to sell it on a stock that I want to own. It doesn't work very well if you keep getting put to stock, and once you buy the stock keeps going down, right? Just like buying stocks that go down isn't a good strategy either. All right, managing puts if stock rises quickly and maximum gain is generated. That's also a thing too. If the stock runs hard to the upside and all of a sudden your put is trading for very little capital, right? You can buy the put back for, you sold it for $5.25 and now it's trading for a dime because Nvidia made the strong bounce back in a, you know, quickly or so. You might want to just buy it. You just close the put. You close it and you release that capital to go and find another stock that you might want to sell a put against. It could be Nvidia again. You could just sell another, close it and sell another put closer to where the stock is at using the same criteria that you did when you first entered this trade. Okay, determine what to do with a stock that drops substantially, and that's what we went in great detail on that, so I'm not going to talk about that anymore. Here, there's a short put scanner that I'm going to highlight inside here. It's updated short put scanner that's inside the Options Play platform, available to all First Trade clients. It's sort of by highest annual yield. You can do different opportunity. But in this instance, we're talking about yield. You can do it by price. You can do it by the name of the company. You can do it just by the premium, not yield, but the actual premium of the option contract. And I'll talk a little bit about that once we get there. Okay, and then we're going to go through some portfolio tracking. You can track all your short puts inside the portfolio. You got to add it to your position. So we'll talk a little bit about the paper trading app, and it will track your cost basis and give you alerts. You might want to take profit. You might want to roll your call option, highlighting that option contract is in the money now. A couple of other ones that are in here are dividend risk. The stock's going to pay a dividend. Are you aware of that? Okay, the dividend risk. If you have a call option, it's a little bit more chance of being assigned when a dividend gets paid. That's for a different date, but we will highlight some of those things inside your portfolio. And the screenshot here is from a Wheel Strategy portfolio that honestly Tony put together, the chief option strategist. And he's going to talk about that here in a couple of weeks, the Wheel Strategy portfolio. So manage positions across multiple portfolios. You can add as many of these as you'd like. Alerts on action items such as taking profits and cutting loss, and the net profit and loss calculations for all positions. So in this instance here, well, let's look at one that's a winner, right? Back in the day, this wouldn't be a winner right now because the airlines are getting beat up. But United Airlines, you had a cost basis of $38 on these short calls, and the mark is 43. That means you had right now a 13% profit on that position, which translated to $1,056. Or if you had a loss, right, on this 3M trade here, it looks like this was short. This is the covered call side of the thing, short 2 covered calls. The cost basis was 130. It's at 126. You're down $830 or 3%. So, and if you click the more detailed thing, it will give you a more detailed outlook of your position. So you get obviously more details if you click the more detail button. All right, so let's go back and look at how this works. So this is the live option trading platform. I have NVIDIA up at this point in time. Wow, the stock's really moving. $7.14. It's up 6% today. Here's the searches. These are the searches that are available. We're focusing over on this side of the equation. The short put search, there's other searches, covered calls, technical analysis. So you might do technical analysis to try to find stocks that you wouldn't mind buying, and then put those stocks in a watch list, and then look for the short puts. Oh, that's why I've already. Usually short puts would be offered in here, but it's up here because I've already done the search. And one thing that's also nice too is that if you build a watch list, I have puts for income watch lists, stocks that I might be watching, that I might think about doing a short put on to buy the underlying stock. And I made my own watch list. If you don't make a watch list, that's fine. We will do the search for you based off of ones that we think might apply. But there's many different watch lists that I have available. There's 4 different watch lists. I have one called daily, one called sector ETF, one called short puts, and one called income puts. And it's looking at all those stocks in that watch list, and it's highlighting here that there are 22 stocks. Oops, let's go back to short puts. There are 47 stocks in the watch list that meet the put criteria for selling put options on a position. Now, a couple that we're doing it based off of yield, and yield kind of goes hand in hand with volatility. So keep that in mind. This strike is the 41 strike on SMSC. Stock is at 42.80. On an annualized basis, it's saying if you sell this 30-day option, DTE stands for 30-day, the yield would be 120. And we're sorting by yield. So this is 120, this one's 107, this one's 84, this one's 84, this one's 84. And as you go on down the list, it's highlighting that. So here's actually Chinese Tesla, if you will, Chinese electric vehicle, Li, and this is a $29 stock, so it's $30, $3,000 to buy 100 shares, and it's returning a strong yield of 72% on a 30-day basis by selling something that's $1.34 out of the money. Not a bad one. Also highlights that there's earnings. If earnings are coming, it will highlight that, because it's important to note that you have the risk of the earnings. As a matter of fact, if I click this, I can actually sort. If I want to look for earnings, I can sort via the earnings date. So I can make that a sort. Right now, we're not in the middle of earnings season, but there are a couple out here. Chewy is one of the stocks that's going to be announcing earnings, and Delta Airlines, which has gotten beat up, is going to be announcing earnings soon. And here's it's highlighting when the next earnings report is. NVIDIA already announced, as I mentioned, so they're saying that it's going to be after the market on the PM, 77 days away on May 28th. All right. So NVIDIA. Let's go and look at it. So let's just click on it, and I'll show you what my slide showed, right? Right now, the yield is 60% on a 111 strike with the stock at 140. So it's came down, and that's mainly because implied volatility has came down because the stock is starting to move up on a 30-day basis. It is highlighting over here that we have a bearish outlook on NVIDIA. And here is bearish and bearish. So in general, this would be a counter trend. The marketplace is not looking good. I got to grab water one more time. And so if I click on this, first of all, it's going to highlight an option contract. All right, hope my internet's kicking. Everybody seeing me okay? I think my internet's keeping up. All right, there we go. So if I click on this in the short put yield, it's going to suggest an option contract that has a decent amount of yield. So in this instance, the first one that it comes up with is exactly 30 days away. The yield is 5%. We were getting 5.25. It's probably a little closer to the money. No, it's 4 points out of the money. Yeah, we were 4 points on the other one. 115 down to 111 is 4 points, and add that 82 cents in there. And on an annualized basis, because it's a few more days, that affects it, right? We were looking at a 25-day option. Now this one is recommending a 30-day option, and that means that the annualized yield is going to come down, and it's around 80% annualized yield across the board. Now, if I close this, right? If I close this, it now shows me this grid, and it shows you option contracts within the grid that meet your criteria. Now, up here, I just want to highlight this because to me this is a little bit confusing, and I'd like to change this a little bit if I had my say in it. But do you own shares of NVIDIA? If you click yes, it will do calls. If you click no, it will do puts. All right. So in other words, I'd rather just have it be a toggle that says, covered call or cash secured put. But this is the way that it's addressed inside the platform. Now, if you go down and you look at here, here's the options grid. I highlighted the Greeks tab for you. And the recommendation here on this one, is it doing the April 4th expiration? April 11th. No, it's keeping that one put on. So if I click on this, this matches your income settings. Let me look at the income settings. Okay, I changed it around. So it's highlighting based off of your risk tolerance, conservative. If you want to own the stock, you'd go aggressive. Conservative means you got a less chance of me putting in stock. Shorter term options. And so because of that, it's highlighting the further out of the money option contract. So if I click aggressive and I save that as the default, and I go back to the options grid, well, let's start from over. Income settings, aggressive, okay. And now I click on NVIDIA and I reset it. The first thing that it's going to highlight is the put option that is most recommended by the Options Play platform, which is going to be fairly close to a 5% yield almost all the time. Sometimes if you got to go a little bit further out, it might do that to try to accomplish that goal. Because I think personally, especially if in a passive management situation, I'm willing to go to a 40-day option contract to get a little bit more yield, to have to manage less if I'm incorrect on my forecast. Okay. Now, if I click the 111 put, it didn't grab it. I don't know why. We're selling the April 4th 111 put in this scenario. The 111 put, which is 23 days away, right? If it's 23 days away, and that's what's being recommended within the 20 to 39 day range, I click on it, it puts a blue box around it, and it's telling you that's a 4.4% yield. And this is probability of being assigned is a probability of expiring worthless is 57%. So you're talking about a 43% chance of it being assigned and you buying the stock, fairly close to the delta that we're talking about. You click the 106 put, now you're going down to the 96 level, 23. You go down to the April 4th, now you're talking about a 1.76 yield, 31%, all the way down to the 100 strike, which is 6 points away on the downside. You want to do a further put, you want to check out the same type of delta or probability of expiring worthless on the 104 put. Then you look at this, and now you're increasing your yield, of course, but you're going out 44 days which is within this range. All right. And it just makes a very simple grid to be able to adjust that trade if you would like. Now, if you're in this one, and we went back and we looked at the 30-day trade, right? So let's look at the 111 and let's modify this. So now I have the 111 trade. I'm going to make it look at midpoint prices over here. That's what it's going to quote, something that's right in between the bid and ask. You'd have to adjust that on your trade, but I like when I'm doing my research to look at what the midpoint between the bid and ask would be. And if you have a question on that, please feel free to let me know. And if I click this, and we're going to go out to the 30-day option contract, and we'll look at the 111 strike, and over here, it's going to highlight the delta. So the 111 strike by going out to 30 days means there's a 36% chance that the stock would reach that strike. We're going to get, well, over here it's highlighting 520, 525, which would be the midpoint on that option contract. And if I click on this and I modify that trade, it now goes back to that original one that we were looking at, which is a 5% annualized rate of return. Want to go down to the 30 delta, it's right here. So I'm showing you many different ways to get to the same solution here. 30 delta is returning 40% with 30 days to expiration, 30 days to expiration here. Break even is 103.85. That translates to your cost basis. If you get put to underlying stock, a lot to play with here, right? And it also kind of highlights stocks that are in a bullish trend. So Bubba is actually one of the stocks that we put out in our research report, which is available to all nowadays. Tony does it every Monday morning inside the Options Play YouTube channel. But Alibaba is a stock that has had a little bit of a breakout to the upside, actually, right down here in this range, and it's trading in here. So it's been choppy since the breakout after a long pattern. The pattern was right around 110 where it really broke out at. And it's saying, okay, if you sell that put and you do the 30-day put close to the money, fairly high probability that it's going to be assigned, 48% chance of it getting assigned, 52% chance of it expiring worthless. You can yield 4.6% or 43% on an annualized basis. You're bringing in $5.93 on a $136 stock. You're 2 points below the market that you're at. And once again, if you close this out, it will show you things that match your risk tolerance within your options grid. And I guess I'll have to sign out and come back in to have that change. Okay, so a couple more questions and then we'll call it a day. Yeah, right at an hour. Oh, hour and a half. Yeah, we gotta run. What do we have here? Okay, here's the next question. If you have NVIDIA but not up to 100 shares, will it select yes or no? You have to select yes or no. Inside your portfolio, this isn't going to be attached to your actual portfolio. If you want to build a portfolio of stocks, this is where the paper trading app comes in. And I think we're going to go through a lot more detail on this on the wheel strategy that's coming up, but I went obviously way too long here. You have to decide this because it's not attached to your first trade account. Okay? And if you have 30 shares, that won't work. You need to have 100 shares if you're going to sell a covered call, and you need to be able to buy 100 shares if you're going to do a protected put. But this is a position where I have a short put in on Disney based on, and just to highlight this is the cost basis. This is where the put is at. This is showing that this position, since I put it in to the paper trading portfolio, right? The paper trading portfolio is down $306 right now, or it's basically doubled in this instance. And if you click this notification, There's a bullish trade idea on Disney right now that is listed inside the technicals if we go to Disney. All right. All right. I think I answered all the questions, and I think I need to stop at this point in time. I can't believe I went an hour and a half. Thank you so much for coming. We care a lot about education here at Options Play, and we try to build you tools to make you a better option trader, especially cash secured puts. Yeah, the next step, and nobody asked the question. What happens if you don't get put the stock? Well, you can resell it. You can resell the stock if you'd like, and resell a put option. And my biggest thing is what happens if you don't get put to stock? You were looking to get put to stock. If you don't get put to stock, what type of yield do you want? And that's the question that you want to try to address. And if you can routinely make decent yields on a monthly basis relative to the dividend, above and beyond any dividends that the stock may pay if you own the stock, it's a decent way to add income. So think about retirement accounts. You can do this in a retirement account. This is if you get the right approval level, you have to fill out that app, and you want to say that you want to do cash secured puts. But as long as you have defined risk and you have the capital to pay for it, it's not much different than putting in a limit order in your account. All right. There are a couple things that we didn't quite address, uh, like exactly when we would get put the underlying stock, but that's going to be for another day. So thanks for coming, everyone. I will put up my information right here. My name is Brian Overby. My book is called The Options Playbook. All the content is available for free at optionsplaybook.com. The site that you log into day in and day out, is connected to your First Trade account, is optionsplay.com. And if you want to follow me and know what I'm doing, follow me on x.com. My handle is @BrianOverby. Thanks for tuning in today and sticking with me for how long-winded I was. It looks like you all stuck with me based off of the number of people that are here. Thanks for stopping in, and we'll see you in a couple of weeks to tie all these strategies together, the covered call and the short put, and that strategy